Trump's new 900-page tax bill just became law, and while it extends many of his 2017 tax cuts, it also introduces some pretty serious changes to the social safety net. If you are in a high cost of living state, a parent, student, senior, part of the working class, or dependent on benefits, then I'm going to tell you exactly how this bill affects you. Let's walk through what's really in this bill and what it means for you and your wallet. First, the state and local tax deduction cap, also known as SALT, gets raised from $10,000 to $40,000 starting in 2025. That cap will increase by 1% each year through 2029, but in 2030, it reverts right back to $10,000. And if your income is over $500,000, that $40,000 deduction starts phasing down, which means for high earners, the benefit starts shrinking. This is marketed as a win for people in high tax states, but in reality, it's temporary and mostly benefits the upper middle and wealthy while doing little to fix the long-term tax inequality baked into federal deductions. Now for parents. Starting in 2026, the child tax credit increases from $2,000 to $2,200 and will be indexed for inflation after that. There's also a new program called Trump Accounts. If your child is born between 2025 and 2028, the federal government will contribute $1,000 to a tax advantage account you can invest on their behalf. Families can contribute up to $5,000 per year. It sounds helpful, but at the same time, the bill caps Parent Plus loans at $65,000 total per child, or $20,000 per year. And after July 1st, 2026, those loans will no longer qualify for income-driven repayment plans. That means more limitations for parents trying to help their kids go to college and fewer options for those who are hit by financial hardship later on in life. Students don't fare much better. Graduate students will lose access to the Grad Plus loan program starting July 1st, 2026. Instead, they'll face new limits, such as $20.5 thousand per year for grad students and $50K per year for professional students in fields like law and medicine, when tuition for most of these kinds of programs far exceeds that amount. Total borrowing is capped at $100,000 for grad students and $200,000 for professional students. These new limits are also paired with the elimination of current income contingent repayment plans. Borrowers will now have only two options: a standard repayment plan of 10 to 25 years with fixed monthly payments, or a new repayment assistant plan based on adjusted gross income, but stretched over 30 years. Either way, this creates more rigidity and longer debt timelines for students already facing significantly high tuition costs. I'm going to pause here to make sure that this video stays short and in a snack-sized bite that you can digest. So be sure to go to the profile of this page to look for the second half of this video.